We've received a lot of questions related to planning for or transitioning into retirement. Specifically, can I retire during COVID or honestly any year with a really notable market downturn? We did have a number of clients retire at the end of 2020, and I'm really happy to say that none of their plans were derailed by the COVID or any of the other challenges that came along with 2020. But right now, let's take a look at some of the key concepts that help them remain focused and will help you remain focused regardless of what the environment is. So first, don't focus on planning to retirement, focus on planning through retirement. The coronavirus pandemic and the volatility that came with it have caused everybody to review and reevaluate their ability to retire as well as their capacity for risk. But we need to remember that volatility is a short-term proposition, whereas retirement is a long-term proposition. Keep in mind that your time frame isn't going to be measured in months or years, but rather in decades. So the conversations that we had with this year's retirees back in March really focused on the fact that they didn't have a 9-month time horizon, but they had a 20 to 30 year time horizon. Secondly, don't try to time the market. We're just not going to get it right. Too often, market timing results in us selling investments at or near their lows, essentially when we're really scared, and then repurchasing the same investments after they've recovered, basically when we feel comfortable again. And behavioral finance tells us that our brains really haven't evolved that much from our caveman days. Every decision at the core really comes back to fight or flight. Remember, if your overall investment policy or your strategy was appropriate for your situation before the coronavirus volatility came, it's appropriate during that volatility too, and it's going to continue to be appropriate after the volatility passes unless there's some dramatic change in your personal situation. And finally, we need to have a realistic understanding or expectation of market volatility. We need to understand that, number one, volatility is never going to go away, and number two, we need to be prepared for at least a 20% market downturn in the stock market every 3 years for the duration of our retirements. Like I said, we can't market time our way out of it. We need to understand that we'll get through these periods with a strategy that's appropriate for our situation and with a portfolio that's built to handle the downturns. So success over time is really going to look more like limiting downside participation versus being completely immune to the volatility. With all that said, the real key is to quantify your situation with retirement projections and update those projections as your situation changes. And know that there's going to be volatility, but focusing on the long-term performance relative to your plan and your goals will help you get through the volatility.